Hey, I wanted to create a video today on why buying businesses is subjectively better than most things out there related to building up active income or just getting a better return on your capital. There's a few things out there that you could do if you have some liquidity set aside, and you got to understand what those things are to be able to build more active income and build up more wealth and get better returns on your capital. So. First things first is what you could do with your capital is you could put it into the stock market if a S&P 500 market. Typically, on average, you're going to get in between 8 to 10% annually on your capital. So let's say if you put 100K in, you're going to get 8 to 10% annually on that. And essentially, the play there is long term. You're looking at a 30, 40, 50-year horizon, but the quicker you start doing that, the better for yourself. Second thing is you could do bonds, which is up to 5%, 3 to 5% returns, which is a very low risk investment, and you could put it into that market. Then you can also do multifamily real estate or real estate investments, and typically the best asset class in real estate, from what I've gathered, is multifamily. And depending on what value add you do on the real estate, you could get up to 15, 20%, in some cases a little bit more, 25% return to capital annually, which is fairly high. Now, most people don't get those returns. Most people stick in between 8% up to 15% in real estate multifamily. And a lot of these deals that you invest in real estate involve debt and require a bigger down payment. And we'll look into that as well. And remember, it's like cryptocurrencies, Bitcoin. Bitcoin last 7 years, compound annual growth rate on that last 7 years was close to 31, 33%, which is very high, but it's also very volatile. So if you look at some of these asset classes, you will understand that these are your options when you have some money set aside. Let's say you have 100 grand and you're in US, you have that money set aside, you want to make that capital work for you. And you want to maybe build up more active income out of that. Now, what active income can you build out of bonds or stocks? You're not able to really build active income out of that. What active income are you able to build out of multifamily? You're able to build some active income out of that, but if you're buying, let's say, you're using a hard K, you're not really going to be able to get into a very big multifamily deal unless you're going to do it with other guys that have a lot more capital, which means your cash flow per the assets you will own is going to be fairly low, depending on what market you're investing in and so forth. It's probably going to be of a couple $100 of a couple $1,000, depending on how you structure the deal and how you do it. And what active income you're going to have from Bitcoin or from assets such as cryptocurrencies. You're not going to have any active income because really you're buying and holding. So you're playing a long-term game in most cases if you want to really get more value out of that asset. Now, as far as buying a company, buying a private established company, let's say you buy a plumbing company local to your market from a retiring baby boomer. You get an operator that has a license that was a master plumber. You integrate them in that business. You give them 10% of that company. And let's say you bring in an additional 100K into the company to buy it out. You get an SBA 7A loan. You have fairly good credit. You get approved for that. You get pre-qualified for that. And essentially, you would buy into that business. So you'd buy 90% of that company because you gave 10% to that person to get the license properly and to be able to operate it properly. Maybe you're not an expert in commercial plumbing and residential plumbing, and they are, and they've done it for 20 years. And the owners is retiring, they're selling. Why they're selling it is because they want to retire. They want to get out of the business. They're tired running the company. They're old. Maybe they have health issues. Maybe they got divorced. Maybe something else happened in their life. The company, let's say, is cash flowing 700K in cash flow annually. So based on that company, the multiple is close to 3x on that net profit. The company, let's say, is worth 2 million bucks. So you put 100K in the deal, that's 5% out of a deal. You've done 5% seller financing, meaning 5% of a total value of a transaction, which is 100K, is going to get paid later. to the seller. And then let's say you got 90% or maybe a little bit more even from a 7A loan, and maybe you've included some additional working capital into that. Well, with some of that money, you can buy 95% of a company because you put 5% down, you got 90% from SBA 7A loan. And that way you own a company worth $2 million. Yes, you have debt, but you also have debt in real estate. And if you're getting into those other markets, it's very volatile. You can just lose your 100K. Now, if you get a working capital in your deal as well, you can get your 100K fairly back if you know how to operate that company and you're gonna grow that company in the next 12 months. So not only you now have active cash flow of around half of that 700K because you're gonna pay off debt and you're gonna pay off seller financing eventually. The seller financing is going to be on standby because the first position note is going to be the bank. You're going to pay the bank back over time. So let's say out of that 700K, you're going to have expenses to pay off the loan, but you're going to pay off the loan of around 350, 400K, let's say, right? You're going to try to pay it off as quick as possible. Now, the loan amortization time when you're paying off a loan is typically 10 years. So you have enough time to pay it off. Maybe you can pay it off a lot quicker, which is good for you. So now you have a business that's cash flowing 300K. Now, of course, I'm assuming that you're not a lazy person. You want to actually work and you want to do the job. You want to manage people. You want to improve a business. You want to keep track of what the manager is doing that you gave 10%. And you're trying to improve a business. You're trying to maybe buy a second business. You're trying to resolve the challenges in that business to make it from 2 million to 3 million in a time, to make it from 2 million to 5 million a time. So we're not assuming that it's standing still. People might say, hey, but what if the cash flow drops to zero? What if a business disappears in 3, 4, 5 years? Well, it might happen, but you might also lose all your money in real estate. You might also lose all your money in Bitcoin with the same analogy and the same logic. So it's up to you to understand the fundamentals of that business to execute it properly so that you can increase your return on capital and active income. It's not on me to do it for you. So if you understand the business and you have a knowledge base and you have a skill sets and you're going to build up your skill sets over time using some of the key employees and the seller and the manager and other people and build a team around it, you have a higher probability of getting it done. You also put in personal guarantees on real estate, not only the business, so there's also risks related to that. So in time, what's happening actually is you're building equity in the company. You're going from 2 million to 3, 4, 5 million, and you own 90% of that. When you take the debt out of a deal and you paid off the whole debt amount, now you own $5 to $6 million in net worth, right, out of that deal. Because if you sell this company to somebody else in 6 months that is also looking to acquire into a company, now you actually made that money yourself as a seller. Not only that, but you've also made 300K plus, and if you've improved the company, you might make a little bit more than that annually. Now, a lot of that money goes back into the balance sheet and into the business to improve a company, but you can still make a fairly good salary out of that. So you can make a multi six-figure salary out of that. Plus, you own a company that's, again, increasing in enterprise value if you're doing it correctly. Plus, you can actually buy other companies. You could buy a different air conditioning company and create a complementary service in your market, or buy whatever, a pest control company and offer pest control services to the local community and do different things. So that's how you can build a lot more wealth a lot quicker, and you can increase your active income and both for your return on capital. And buying private companies are fairly stable companies. Why? Because you're going to look at the last 5, 6, 7 years of a P&L of that company. You'll notice that they were making money. And if you're going to do your quality of earnings from an accounting perspective, you're going to see that they were making money. And the seller's been living a good life and they were managing a good business. And they have a good track record. They have customers. And it's not volatile as other assets are. Yes, it's a little bit more risky, but it makes way more cash flow than Bitcoin. It makes way more cash flow than real estate and way more return on capital than any of these other assets. So this is how I prove to you that buying a company is a lot more profitable than anything else in the market today. If you want to buy a company in 2026, send me a message on LinkedIn and we'll analyze your situation. We're going to look into your current situation, your goals, and see if we can help you acquire a company in 2026. Thanks for watching.